2014 and prepare for a phenomenal, what I believe will be a phenomenal trading experience for 2015 for those that are prepared and have, I think, better analytical skills. And that's what it really is all about in this day and age. And there's so many different opportunities for trading in futures. Now we have with equities and ETFs that mirror futures markets, and there's just, of course, options and optionable strategies out there and spread opportunities. There's just so many different ways to trade the market now. And of course, with the electronic era of order entry, there's only one caveat that can really go wrong, and that's if you make too much money, you're going to be forced to pay a higher tax bracket. And two, the next thing that could possibly, only thing that possibly go wrong is that you have a bad internet connection or no internet connection, and that would hinder your trading. So, but we do have a very special event for this morning. We are recording this so that everybody can have access to this recording link. Myself, John Person, some of you may not be familiar with me. I've been around for 35 years, started at the floor of the Chicago Mercantile Exchange. I am a member of APTA, I guess a subdivision of the Market Technicians Association. It's a voted, you have to be voted in by 3 members from the MTA, so it is quite an honor to be a part of that organization. Also, we've created several indicators, extremely popular indicators. Many of you, if you're familiar with Thinkorswim trading platform, you'll find my Person's Pivot and the PPS indicator, which we'll talk a little bit about today, on their on their trading platform, as well as Person's Pivots on TradeStation Securities, one of the most popular and highly sought after, most downloaded trading app on the trading app store on TradeStation, I was told last month. So that's pretty amazing, as it's helping people to navigate these markets. We have a special guest and co-presenter today, Dr. Adrian Manz. He's a PhD. He's also the co-founder and daily contributor to Traders Insight. His website's Trader Insight, excuse me, no plural, traderinsight.com. And he does a lot of really good work with markets, especially with gaps, and I believe that's what his presentation will more talk about. So there's not going to be an overlap. You have 2 different speakers with 2 different styles of trading that I think will benefit everybody in the room today. So I'm excited to do this presentation with Adrian this morning. So welcome, Adrian, and welcome everyone for being here. So let's get started, and we'll get right into my presentation. First and foremost, as a registered commodity trading advisor, some licensing that I've kept for decades, basically the government would like me to make sure that I share with people that trading is risky, and this is an important disclosure and disclaimer. Also, it is, as you can see, trading is risky. Past performance is not indicative of future results, especially when we talk about some of the trades that we've done in the last few years, and not every trade works out every single time. So remember, past performance is not indicative of future results for any trade. This is a presentation educational in nature, and of course it is unlawful to record this presentation and reproduce it, distribute it, or exhibit the material to anyone other than individuals assigned, which means that this is for your eyes only and for your benefit from an educational standpoint. So with that said, we've got that all out of the way. Let's think about it. We've got till 2015. What does this really mean? Everyone, I think if you've been an active trader like we have, it has been, I mean, it's just like every day is like, okay, when is this going to end? I mean, it's just like been a golden, I wouldn't have to say a golden child, but it's been silver platter. There's been something in the markets for almost every trader in the last quarter. I mean, literally since the August peak, there has been something in this market. We've had an exciting earnings season. We had an incredible November. We've had an incredible December. The Janet Yellen save, bringing the gifts back to Whoville from the Grinch who stole Christmas. I mean, the January effect, the Santa Claus rally that happened last week, and of course, is the Santa Claus rally going to continue, and how much is left of that Santa Claus rally? So with 5.5 trading days left until 2015, we need to kind of start to prepare and plan for the next big event, and there will be big events, and I think what is really neat about taking during time off during the holidays is to reflect on where certain sectors have gone, so that, and where they might go, and that's where seasonal analysis could help you, so that you can kind of capture the big picture and capture a big trend move. Just a few weeks ago, we positioned ourselves for, and as many of us are mostly stock traders and stock and equity options traders, at the Las Vegas Traders Expo, we did this big analysis on live cattle. Believe it or not, not many people are interested in trading live cattle. I get that, but they do have an ETF called COW, C-O-W. But needless to say, my work as part co-author and editor of on several books that I've written, one of which, of course, is an almanac, the Commodity Traders Almanac, in fact. And as part of doing that that series of almanac for the last decade, it was published through John Wiley and Sons. It was available on Amazon. The neat thing about that was to be able to look at some seasonal events, and many of you may remember, or maybe it just reflects in your mind from a decade ago. Literally, I think it was about 10 years ago to this week, was two important things happened in cattle. First off, the CME celebrated 50 years of live cattle futures trading. That contract is 50 years old. Second, it was the 10-year anniversary of the mad cow scare, where cattle prices were locked limit for approximately a week. Well, we were positioned because it's not just a matter of where whatever the catalyst is that makes a market move. It's the event from a supply and demand function of the market, and that's what really seasonal analysis helps us uncover. Certain years you get a bigger move. Certain years you might get a magnified move or a muted move, as we like to say. In other words, not all outcomes are the same, but you can prepare, and there are certain techniques and tools that you can use to stack the odds in your favor, and that's what we look for. So at the Traders Expo, we talked about how people could position themselves for as little as $400 to $600 on out-of-the-money put options for February expiration, and quite frankly, our profit objective was hit rather immediately, and unfortunately, it was the one trade we did not scale, and I'd just like to admit that, because we do have some people in here in our community of today's presentation that took part of that trade that know. It was the one trade we didn't scale out, and it hit our profit objective for personal reasons. We flattened the position out, and cattle prices continue to plunge from about the 171 to about the 155 handle. I mean, that was approximately, believe it or not, turning about a $400 option into almost a $5,000 value in just approximately less than 5 weeks. So big move, and I'm talking intrinsic, not delta appreciation, or there was delta appreciation, of course, but if you're an option trader, you know what I'm referring to. Big moves coming in the market, and that's just some of the tip of the iceberg of what we see. And so today's presentation will discuss some of the exciting trades that an analysis that we've made. In fact, I started a pilot program earlier this year. I'd like to share with you, if you're not familiar with this, before we get started. And in the fact that the pilot program was to tweet to help people through via social media. And our website, Person's Planet, it's free of charge. We started this to put out actual trades, not after the fact, but well before the fact. So for example, last week even, we talked about, as you could see, on December 15th, and I'll just pop this up and we can go look at this for a quick sample. At 1 o'clock in the afternoon, we were buying calls and telling people, look, you can buy calls in the IWM, which is the Russell. We're looking for outperformance of the Russell via, from a relative strength perspective, looking for the Russell to outperform the S&Ps to the upside. Or you could look at TNA. And we were also selling the knob spread on a 1-to-1 basis rather than the exchange recognized margin, which is a 3-to-2 or a 2-to-1, but we were selling the knob, which means you're short the 30-year bonds and long the 10-year notes at 17, 29, 30 seconds, and you do that through Martin Luther King Day. Now, we came out of that trade because we got a quick, immediate profit on that, and as I'll share with you real quick, we actually announced that and follow up with those trades. And so we actually talked about a heads up on Twitter, which formed a high close doji pattern. So this, you can go over and look at these the tweets and see all the tweets and all the wonderful analysis and actual trades that we've put out there to help investors understand what's going on in this world. Because first off, a lot of traders are scared of the market, got burned on the market, and really have had a hard time understanding what to do because there's, I mean, so much information out there that's been confusing. And this is what people have told me, especially when we go to the seminars and do these live in-person seminars and we do these traders expos, that a lot of people are just, with the mass amount of information coming through, people talking about get out of your positions on the crash in October, but you know, don't get a part of this move. And you know, it's just been so many conflicting stories. That's why we earlier this year, at the beginning of the year, we started this pilot program to send tweets. We built it up to almost, I believe, 45,000 followers. So there is some good coming out of that, and that's what we have started. So for today, what I have planned is to discuss what sectors and subsectors have become over or under or outperformed or underperformed relative to everyone else. And so I could tell you straight off that the biotech sector is on fire. We've seen the energy sector totally decimated. And I think what we need to do is prepare for the coming year and what's happening in the next, say, less than 40 days, in the next 40 days, let alone the next 5.5 trading days. What's happening in the next 40 days is real simple. We've got an end of the year event, a beginning of the year event, and there's a lot of things that occur during those time periods. And then we have the typical January sell-off. Then we come into earnings season. And then the best time of the year to ever buy fossil fuels is the first week of February. The worst time of the year to ever buy precious metals, especially gold, is the last week of January. So from a seasonal perspective, there's a lot of things that we can look at and start to plan for. Needless to say, next week, you know, you're going to start to see from a European standpoint, they take off 4 days in a row. London has what's called Boxing Day. So Friday is going to be kind of a quasi-holiday. You can do two things. With the lack of traders, have lower volume levels, which can cause markets to move or cause markets not to move. Either way, if there are big moves that happen next week, in my 35 years of experience, I have seen where we've seen exorbitant moves in a market the week of Christmas, all to be taken back the week after Christmas. So you want to watch for that if you are trading in the markets and you keep your eye peeled for that type of situation. So I always tell people, in order to figure out where prices may go, you kind of got to see where they've been. And here's what I think every trader really needs. And if you're an option trader, you'll note that a lot of option educators teach people how to, quote unquote, adjust your position. Adjusting at a position is a polite way of saying you've got a loser on, and you're going to, all adjusting is putting another position on. It's kind of like adding to a loser, so to speak. I mean, that is just the polite way of saying, hey, you got a loser, but don't give up on the trade, give up on the time period, your duration was wrong. But I think if we have better market analytical skills, then you will be doing less adjustments. So I think it's also important to have knowledge of what type of trades to do, knowledge of triggers. Number one, what constitutes the point of energy of a breakout? What constitutes like, for example, after a period of strong trend, we go through a period of consolidation. In that consolidation period, if it's a wedge or a channel, to be able to identify at what point in time and point in price a breakout or trend resumption or reversal will occur. That is information that will help any option strategist identify A, the duration of a trade, B, the expiration time cycle. So combined with seasonal analysis and some information I'm going to share with you to walk away with today that you can apply immediately, I think it's just important to have that knowledge that if you're using a breakout, you need to have a stop order, but if you're going to do an option, to keep your eyes out on specific strike prices and levels, because the last thing you want to do, a stop order is kind of a market order once a price is hit, but to go out and use an option market order is, in my opinion, fairly suicidal. So with the advent of computers to be able to set alerts and reminders out there for you, that is something, and there's I mean, 20 different ways to get alerted to a trade price breakout momentum analysis. Trading rooms, emails, instant messaging, mobile applications, the list goes on and on. That's why I say this is the time frame of our for the trader that has had the best advantage of if you just know what to do. So and how to take advantage of that information. Risk management, trailing stops, placing stop management. You know, everyone talks about, hey, how much money you can make in the market and what a great move things are, but what few people talk about is how much risk did you have to assume in order to make that profit. That's what's really key, and I think you have to really respect risk on any trade strategy that you take under consideration. In addition, proper position sizing, something I've been teaching for decades, is that what I was taught. Take a portion of your risk capital based on risk for any one trade. So these are the kind of things that I think that we need to really look at, and most importantly, understanding markets' trend stages, like I've just mentioned, trend, consolidation, and that may help you understand and determine option strategies and directional strategies if you are an option trader. Now, this is not necessarily an options presentation, but I know there's a lot of people out there that are trading options, and an increase in options. I've been trading options since 1984 when they were first introduced on Treasury bond futures, so I have a little bit of experience on both options analytics and as well as options trading from a realistic standpoint. So with that said, a little bit of experience is coming your way, just to put it mildly. Ability to anticipate market opportunities, and that's what this is all about, is we have 5.5 days to a new year. My 12-step program, what do I do to help determine that analytical skills? Well, I use my PPS buy and sell triggers because I can scan for those and a definitive buy and sell signal. I have my candle patterns, the high close, low close doji, which has been published for now well over a decade, and they're easy to scan. My person's pivots to help me define the trend direction to determine support and resistance for most time frames. And if you're not familiar with the person's pivots, it's based off of Floor Trader's pivots formula, but there's a moving average component that gives us and filters out and helps us to determine what the market condition is, whether it's bullish, bearish, or neutral, and under that assumption gives us defined one support, one resistance in various time frames. I was the only person, and we created a pivot time frame which included longer-term quarterly on the financial calendar. We created the pivots to be used for option expiration rather than monthly calendar expiration, which has been instrumental to help a lot of traders, especially the options trading community. And that is a very popular time frame to be used. Next, I use, without a doubt, chart patterns. Wedges. One of my favorite breakout patterns is the wedge. Especially combined, as I'll share with you today, a breakout strategy. My seasonal and cycle analysis to help me uncover when I should stalk market. So like, for example, I'll throw this one your way. We've got a lot of stocking stuffer, quote-unquote, stocking stuffers that you may want to follow for trade opportunities. One already started yesterday, unfortunately, and which I'll share with you. But seasonal and cycle analysis, such as like, I know a lot of people have been looking at biotechs and with Ebola, and if you look at the biotech sector as measured by the ETF and the stocks, the symbol is IBB. If you look at the IBB, you'll note that it is almost appreciated 300%, threefold in the last 2 years. Starting January, on or about January 9th, the biotech sector tends to peak out, and it is the one sector that from a end of year perspective, as we'll talk about today, that stocks that are near their highs or tend to be strong into the year's end are the ones that do not are more susceptible for profit taking as people defer their capital gains after the beginning of the year. Stocks that after the middle of the month, December 15th, that are negative on the year tend to stay negative on the year because people like to sell and keep those under selling pressure for tax credit purposes. So there is a list of stocks, and of course there's some seasonal trades that we're going to talk about that have worked over the last 4 years almost to a T. The only difference is some years have worked better than others. I look at volume analysis, and I don't look at volume histogram like many traders do, because in the last 5 years, and this is a very important point, so pay attention to this. In the last 5 years, we've had, with the advent and the creation of dark pools, institutional firms that match their own trades, for example, and the increase in options trading. So if I'm bullish a market, I could sell a put, buy a call. I'm in a synthetic long position. That volume that is in the option is going to be masked and not show up in the underlying stock or derivative product. So therefore, volume analysis has been, and if you're one of these individuals out there in the world that have struggled with volume analysis, in other words, you see a strong trend to the upside, but the volume histogram is showing negative bars or negative growth, or showing lower high growth on a histogram bar, and we'll show that in just a minute. If you've said, well, this rally can't be sustainable because it's on light volume, and yet the market continues to blister to the upside, you've been fooled by that. I think you're not alone, and the logic is because of the increase in options participation, the options volume won't show up in the underlying stock or derivative product. So if you've had problems with volume analysis, there is a solution for that problem, and I'll share that with you today. My person's histogram is an exclusive momentum indicator found only on TradeStation platform. I use relative strength analysis. Many of you might be familiar with this, and it's not the Wells-Wilder RSI index. It's pairs or spread trading. It's comparative relative strength. I'm looking at a stock like Pepsi versus Coke or Pepsi versus Monster, or I'm looking at the utility sector XLU versus the S&P, or I'm looking at Amazon versus the Qs. I compare one product to another, or I'm looking at bonds relative to notes. That's relative strength analysis. I also use the commitment of traders data for identifying, and I know that many of you might be only stock traders, but boy, if you're trading the spiders, the Qs, if you're trading gold, GLD, if you're trading ag products like Caterpillar, John Deere. Caterpillar is an ag in the material industrial sector, by the way. They do make machinery equipment, so we consider that like a John Deere competitor in that space. If you're looking at Monsanto, which is a fertilizer company for the most part, and also Roundup seed GMO supplier, genetically modified. Many of you are familiar with that term. And in addition to others like Archer Daniels Midland, then you will note that a lot of those stocks are highly correlated to their seasonal price trends to the underlying agricultural products like corn, wheat, and soybeans, by the way. I use breadth analysis for stock indexes, my last conditional change trailing stop pattern, and of course money management. That's my 12-step analytical program, kind of speak, that I use. Now, we talked about anticipating market opportunities. Since we're coming to the end of the year, let's talk about the opportunities that exist. And then how does my 12-step program combine into determining whether or not these will work or not. First and foremost, if you've heard of the January effect and the small cap sector, is the small cap sector right now, which is measured by the Russell 2000, or an ETF called the IWM, it tends to rebound, which it has, and it is performing nicely, by the way. And there's so many different ways to trade this sector, such as the IWM, the TNA, which is a leveraged ETF. SCHA is Charles Schwab's own index. I mean, there's so many different ways to trade the Russell. The RUT is an index itself, the futures with the ICE's Russell futures. So there's so many different ways that we can trade this, but it is working, and it is outperforming and has outperformed the S&Ps over the last month. In fact, it fell the least in October, and it gained the most in that time period. So it has given us that bang for our buck, so to speak. Year-end rallies. Well, the higher the market goes, and we've got this year-end rally, and the higher the market goes, the more lucrative the January break might be for traders, that you may want to, in the next week or two, start pricing out February expiration put options. And that is one that I think might be, I mean, every year you just think about, we still need to pay Uncle Sam. You don't want to pay Uncle Sam a whole lot, so you got to have a little bit of Christmas money, so you take some money off the table. But as we get into January, it's like year in and year out, and you know what? Traders forget about these opportunities. Certain foreign markets may offer some intermediate buying opportunities via ETFs, believe it or not. We have one that I'm giving you right now. We tweeted it out the other day. We did another one earlier this year. It was right textbook, right off the lows, perfect buying opportunity, and it was the German ETF, the EWG. This one is Latin America, believe it or not, and I know that crude oil in Cuba has been on the news, and I'm not doing a Latin American ETF, which is the ILF, but I would behoove you to, behoove, what a word, it may tweak your interest to look at an opportunity as a trade with low risk and high probability upside movement, that if we do see all tides float, rising tides float all boats, right? Whatever that saying is. And so we may see and could see a nice upside in consuming developing nations such as some of the countries in Latin America with lower energy prices. And I don't think that's something that's been in the news or been discussed, because everyone's focused on the Sony event and the North Korea and all the headline news. And meanwhile, we got to start digging for our own trade opportunities, and that's what we do. I don't like to necessarily chase a market that's already on the news, but we certainly have some great moves coming. Copper prices, you know, the funny thing is copper actually, seasonal lows occur in copper begin in December. And if you look at the material sector, and if you look at what's happened in the market in the world, and you know, people will talk about the slowdown in China, et cetera, et cetera. Well, the funny thing is we've seen increase in sales. Listen to what's happened with CarMax, right? We've seen AutoNation. Look at some of the car sales. What goes into cars? Copper. And the funny thing is that copper's gotten no respect, and we could see some increase in copper. And as copper starts to base out, some of these like BHP Billiton, SCCO, Southern Copper Peru, there are some good opportunities out there that are coming into play. And again, the key is, I'm sure we could all go with Alibaba. I'm sure we could go with all the hot headline momentum names, you know, but I like to look at what the risk is. What is the risk? And I want to get into trades that the masses aren't in yet, unless I'm looking for shorting opportunities. Next opportunity to anticipate is the fact that we call it the dogs of the year. Negative performers in the middle of December tend to rebound sharply after the new year as we head into April. That's because that tax credit selling pressure has abated. So at the beginning of the year, you start to see people start to accumulate into some certain trades. Now, yesterday, and we did a presentation earlier this week, last week, in fact, we talked about social media, and if there's an ETF called SOCL. SOCL mirrors some of these social media stocks, and this is Yelp, and yesterday we had, you know, Yelp had an amazing upside move. I think it was up over almost 5%. So it had this green support. We have had an amazing move off of what we call a convergence, and what I promised you was to take a look at several indicators. One, PPS is these arrows on TradeStation. I am the first person to ever create arrows on TradeStation. We've cracked the code. So if you're a TradeStation user, you know that for indicators, they've always either been dots or crosses, and now we have arrows, so which is really cool. And that's the same type of indicator that exists on our other favorite platform, Thinkorswim, by the way. So TD Ameritrade, if you use the PPS indicator, Person's Pivot Study, it has arrows, which indicate change in bullish momentum to bearish momentum, or buy and sell signals, as they're aptly called. So this is a weekly chart. We don't have a PPS buy on this chart, but one thing we do have is a convergence of decline in price with an increase or higher lows in the momentum, which says that the bearish trend is kind of ending. The reason I've got this crosshairs is up until yesterday, the market, this is the end of last year, 2014. You'll note that's what this white line marks, that line in the sand. And this is what Yelp has done all year. It's gone a little bit ahead, it's gone a little bit below, a little ahead, a little ahead, a little below. And this is one that I believe is going to be, because of the fact that this selling right here, based on another indicator I use, on balance volume, if you'll note, the level and the amount of volume participation on that decline has been relatively light. So it's a very strong, susceptible market for a breakout going into the new year, and the rally could last going into April. If you look even last year from a seasonal perspective, it was flat, and then right after the new year, Yelp and their business model may support that going into March time period. And I'm not saying we're going to see the same type of move to the upside where we run from 65 to 100, but we could easily see the market get back to where we were just this past September, October, which is around $70. That would be a heck of a move. You're talking approximately 40% appreciation. If you look at what the risk is from the lows that have been established, it's a very low risk, high reward opportunity. Here's another one that many of you may have forgotten about, but remember earlier this year, the financial media really blasted regarding two big hedge fund competitors, right? You're going to love this one, or maybe you're going to hate me for it. Herbalife. But if you can see, going back, and I didn't go back, but in 2011, every year almost, except for, well, even last year it worked, but the construction makeup was slightly different because the stock had rallied into the end of the year, not went down into the end of the year. But stocks that tend to go down, and that's what this hash white lines represent, is the end of the previous year. The funny thing is that Herbalife, as much as people might think it's a pyramid scheme and et cetera, but as a trade, and I'm not interested in investing in this company as much as I'm interested in the trade, right? It does represent a major, as you can see, a major price decline on very insignificant volume, which means that this stock is susceptible for an upside move. At the very least, we're looking for the market to get back by April, which gives you duration, right, to at least the October highs, which is around 57. Let's round, you could say 55 if you want, for all practical purposes. So again, that is another stock that has a very low risk, high reward setup. And as you can see, certain years have performed better than others. Last year was a little bit different, as I mentioned, construction makeup of the stock, but needless to say, I think this year is more representative of the past 5 years. Here's one that I think everyone will probably think I'm just out of this world, but Sears. And Sears has actually worked from a seasonal perspective. Sears, I don't think they're going to file bankruptcy any day soon, but needless to say, from a seasonal perspective, this stock, believe it or not, is one. In some years, we've rallied substantially, like in 2012, versus 2013 was more muted, and even 2014. And I think this year, the fact that, we're just up mildly from last year's close, but needless to say, I think it is another stock that if we get a breakout is one that can at least get back at the top end of the range near the $50 mark, and is another high setup. This is one that I think is so amazing. It's JCPenney. And the amazing, what I mean by that is every single stock that I'm sharing with you right now all have strong seasonal tendencies to move up after January. we've been in these trades for the last 3 years myself, except for Herbalife last year because it had the different construction makeup. In other words, it rallied going into the end of the year. It didn't break going into the end of the year. Meanwhile, JCPenney is one that we've had some pretty good success with, and last year was no exception. We talked about this being more of the stock price was trading at more like an option premium, right? $5. It was kind of amazing. But what's really interesting with JCPenney right now is that even some of the department store names do not start a seasonal trend going into the holiday season, but rather after the holiday season, believe it or not. Believe that or not, and it may have something to do with the change of season going into the spring and the anticipation of more people shopping when it's cold out rather than people shopping just for the holiday season. Part of what the whole process, if you think about being a consumer, why is Black Friday a big event? It's to get people used to coming into that particular store and to get you as a return customer. And if you buy something, you may return it, which means you return to my store. And if you return to my store, you have once you're through my doors, you may be, as a consumer, an impulse buyer and pick something off the shelf and purchase it and then continue to come to my store. And that's why you see, from a psychological standpoint, after the beginning of the year, people start to enter, and there is a seasonal tendency for department stores to gain stronger strength from the beginning of January going into April, incidentally. JCPenney's is no exception to that. So the fact is that this market has, from a technical perspective, we also have higher momentum. We also have a higher volume reading, which means this stock has been in more of an accumulation bottoming formation rather than distribution. So as we see over here in 2011, this strong rally, you didn't really see an amazing move of volume associated with this rally. I mean, if you take a look at from where November took place and this amazing rally that took the stock from 30 to almost 45, I mean, that's a 50% increase in valuation. You saw literally no volume associated with that upside move. So that, and then as the market started to peak out and you got one of those PPS sell signals against Person's pivots resistance, oh my goodness. I mean, you had a 1-2 factor punch. The fact that my momentum indicator was off the charts reading overbought condition, this was not a stock to be a buyer of. So JCPenney's, from a technical perspective, does, as far as my indicators and the indicators that I use, has strong correlation. So right now what I see is that this stock has really gone nowhere, but the volume has gone, as you can clearly see, trended higher, which means that this is more of an accumulation longer term rather than distribution, as what the volume shared with us back in late 11, early 12. So one last one, and I've already mentioned it, is the ILF. So like I say, not all countries are created equally. Germany, you've got your ETF that not just that looks at the Eurozone, but individual countries. You have your ETFs that deal with Germany, Italy, France, right? China, Russia, of course. But here's one that's been little known in the world. It's fairly liquid, and it is been an underperformer, but what's caught my eye is that just based on the rules of the end of the year kind of analysis, because it's just basically, if you think about it, from 2000, this whole year, it's just slightly underwater, like unchanged. It hasn't really melted down, so it's not like affiliated with the like you would think with Venezuela's production in oil. You would think that this stock would have just gotten crushed, right? It's unchanged on the year, slightly lower. But look at the move in the price. From the peak in October, it got slammed. I get that. But we have bullish convergence on a momentum indicator. More importantly, look at this volume. There was very little volume selling this thing off. So this, actually, if you are a fan of Arthur Merrill's work, from a technician standpoint, Arthur Merrill did a lot of work on M tops and W bottom formations. So this would be one of Arthur Merrill's where you see the market may take a lower low out and then immediately respond by an upswing. So this ILF might provide us with some very low risk trading opportunities as we head into the new year. So that's what we're looking for. And I know a lot of people want to hear about, well, what about crude oil? What about this? What about gold? What about, you know, the more popular markets? I get that. But I like to look for opportunities that I can make money on where the masses aren't. And that's what this presentation is, to get people to think outside of the box. I mean, indicators and price patterns that I use, my PPS, my person's pivots. You know about my high closed doji formation. You know about my low closed doji formation. I've just mentioned about M tops and W bottoms, as well as wedge formations, one of my favorite momentum breakout strategies. Also, we have other patterns that we use, and this was actually tweeted out. This insert photo was actually tweeted out. This is the real photo that I tweeted out to the world back in September that said, hey, we've got a broadening top with divergence in the advanced decline. Now remember my 12-step program, I said that I look at breadth analysis. Many people look at advanced decline analysis, but the advanced decline comparative ratio lines that people look at are mostly based, and every single one of them are based off of the NYSE data. Like if you look at the ARMS index, the tick, the TRIN, if you take a look at the McClellan oscillator, all of those indicators are based off the NYSE. One thing that I teach and I've constructed and created was that if I'm trading the S&Ps, and if I'm trading the NASDAQ, and if I'm trading the Russells, and if I'm trading the NASDAQ composite, and if I'm trading the Dow Jones Industrial Average, the logic behind a different way of teaching people to justify another indicator that you have available to you, and this is what we teach people, is that we can construct and look at the strength of an individual index. After all, there are certain times of the year where we do get fluctuations between large cap, blue chip, small cap, which hasn't happened yet this year, as is it starting to happen. Technology, the Qs is not as technology laden as many people think. It's more now become more biotech weighted. In fact, the NYSE, the reason, and I'll give this to you as another stocking stuffer, the reason I don't put a whole lot of emphasis on solely looking at the NYSE advanced decline analysis, what we call breadth analysis on the NYSE, is because 50% of the stocks that are contained within the NYSE are A, interest rate sensitive preferred stocks, and B, they actually contain bond funds that are valued in price, not yield. So if bonds go up and stocks go down, you may get a false reading in your breadth analysis using the NYSE. But if you construct, which we do and have, a breadth analysis comparative ratio line on the S&P 500, and that's what you're looking at here, the spiders, and that's what this is. This yellow line is the comparative ratio line between the advancing stocks versus declining stocks as it relates to the S&P 500. So we think a little bit smarter and logically than the average or above average trader. Well, we tweeted this out to tell people, listen, we have a broadening top. We did a special webinar, in fact, and we had people comment that they've heard this called a megaphone. The correct terminology is a broadening top formation, a broadening top formation. It's tough, it's tricky, because the markets make newer lows and make newer highs, and it gets into a broadening formation. You had a minor broadening top formation with a bearish divergence, meaning the market was making a newer high, but the amount of stocks contained within the S&P were not forming a newer high as well, which showed us emphatically, and as you can see in the middle quadrant, the blue line, it was trending lower. So as prices were moving up, we had a lack of participation, and as far as the breadth analysis was concerned, and we had decline in volume confirming that that rally was not sustainable. And that was one of the patterns that we looked at, that not only did it have an amazing pattern using non-correlated indicators. The OBV indicator has got nothing to do with breadth analysis. In fact, we had a little pink dot here, which was the PPS sell signal a low closed doji. There's a doji, and there's your low closed doji, and you were right at pivot resistance. So we had several non-correlated indicators that were all flashing sell, and yes, we were extremely well positioned for an eventual downside. My famous tweet that gave people the absolute downside, our target on this was 185. Now we did get a little bit lower, but our objective was 185 on this move, and as you can clearly see, that was near our longer term pivot objective. In fact, another tweet, which is really neat, you can go back and follow this up. On October 15th, we tweeted out, we had a high close doji pattern formation at monthly pivot support with an increase in OBV, a dramatic increase in OBV. Now, I don't know about you, but if you're using open interest and volume, I don't know what the heck this volume histogram shares, except for it shared that the downside trade was on increased volume, and as the market started to rally, it was on declining volume. So I think a lot of people probably didn't believe this move. Why did we recommend IWM calls on the 15th? Was because we had a high close doji, we had an incredible surge in volume, and we were looking for the Russell on that rally to outperform, meaning move faster and more from a rate of change perspective than the spiders or the Qs, and we were right and profited from it. So there are technical tools out there to help traders become a little savvier and better, since many traders are using a lot of similar indicators, such as moving averages, which are based on price, such as indicators that are, for the most part, based on price. Bollinger Bands, price-based. MACD, price-based. CCI, price-based. Almost every indicator that most people use is price-based, and then the one that they use, which is volume, tends to not give the true trend analysis because of the fact that volume is being masked due to the increase in use of institutional firms matching their own trades via dark pools, as well as the increase in participation with options. This is the live cattle trade that we talked about, which was fabulous. We had a momentum, we had seasonal, we had a rising longer-term wedge. So when I tell you that I use price patterns in conjunction with my pivots, we were looking at this to move lower. In fact, our profit objective was hit, and this thing just kept giving like a gift of life that we were hoping to see a little rally so we can get back on the short side. But needless to say, we caught this one fully intact and just nailed this one. So this was a seasonal trade. Typically, cattle peaks out on or about the third week of November, and it came in right on line. If you notice, even the high of this whole move was formed by low close doji formation. So it was really amazing type of information. Another one, we take a look at low close doji. So when I tell you I look at price patterns at person's pivots, this is just the other day where we had a low close doji at the predicted pivot resistance and confirming volume decline. So this is what we had the other day on the Russell when we were saying, hey guys, you want to buy the Russell or the IWM or the TNA, and as you know, we had a gap higher opening. Anyway, minor wedge breakouts with bonds. The list goes on and on. Copper prices, as I mentioned earlier, start to bottom in December. Now, they haven't gone up, but they're not going down. And we have bullish convergence. So you want to definitely take a look at, and a lot of the things that I've talked about today, confirming tools, non-correlated confirming tools are very important. In fact, we've had so many trades, and I'm going to share with you, that help us with the two different time frames. My favorite one, QLogic, we did, besides looking at my PPS and person's pivots combined, we also looked at volume analysis. Now I know in our trading community we positioned for options on QLogic as an earnings play because it was just so outstanding. QLogic, no one ever, I forgot who QLogic was. This wasn't last year. This was just this past October. We nailed this one for an incredible gap higher move that no one saw coming. JDS Uniphase. I even forgot who the hell they were, but yet it showed up on our scans as not only a PPS buy signal, you can see the arrow, but another one that we were positioned in directional call plays because the volume was showing accumulation, not distribution. Looking at the weekly, using my two favorite time frames, daily, weekly, we had an amazing move where price didn't do anything, but the OBV indicator was suggesting a stronger upside trend, showing accumulation, not distribution. So it's not that we were lucky and going long all the time. This was Whole Food Mart. We did an open house to the world. We had hundreds of traders in our room, and we did this analysis before Whole Foods came out and said, hey guys, this is showing significant accumulation. And before, and I know, I think we have an attendee today that's in the room that actually took a trade on Whole Foods and significantly benefited from that analysis. So we're not always bullish. This was QCOM. What's interesting in the setup between QCOM is while Apple went up and everyone was assuming that QCOM would do well, the funny thing is our analysis suggested at pivot resistance we had a PPS sell signal. There was no volume. Look at this. Market rallies with no volume behind it. That's not a good sequence of events. This was the other stock that we told people, bullish on Whole Foods, bearish on QCOM. Look at this huge, massive amount of distribution. So while the stock was having a hard time before earnings came out, really convincing the world that it was going to continue higher, there was distribution and volume. Cisco, another great setup based on the analysis. High close doji formation, a PPS buy signal, in fact. So there are indicators out there that we use overall. Amazon, this was a phenomenal trade that we had a breakout, high close doji, increase in volume, and we scaled out. And what we did is we bought options on this one. The 3 double nickel, and we scaled out. We had a scale out program based on a quarterly, which was tweeted out. We tweeted out to get long this, and we tweeted out as a follow-up to investors for free, not an advisory service. And so that is, we also gave this in our TradeStation weekly morning briefing session. So we've had some really neat stuff, and this is just to share with you some of the trades that everyone that I showed you are all trades that I've personally taken on an options position or cash position in the underlying. It's just been an amazing run in the market this year. So the indicators that we use and the teachings that I give have really helped hundreds, if not thousands of traders. And I'm here to offer, if you're not familiar with my work, then, and if you're not familiar with how to use the PPS indicator, the momentum indicator, how to use that for scanning combined with person's pivots, I may give you this special offer today. This is a brand new study course. It will be released and available on Monday, this Monday. We are allowing you to have access to the signing up before we release this to our own website, which if you're not a Trading Room community member, which we did the other day, we're going to extend this offer. It will be released on Monday, but this launch price is $189 for my person's pivots. What's special about this new course, it gives you the best time frames to use to combine, how to scan setups using Thinkorswim as well as TradeStation, the practical purpose for the moving averages, which are overlaid on prices, the practical use for the projected support and resistance. Remember, PPS is one indicator and person's pivots is another. One gives you market condition, that's person's pivots with support and resistance, and the other gives you the triggers. And what the moving averages are for is to help confirm whether a trend is bullish or bearish, as well as give you levels for snapbacks for order entry. And that's where we teach in this special course. We also talk about how to use the scans to tell us what sector analysis strength or weakness is showing. And I included, because we have a lot of people interested in the Ichimoku cloud charts and also Bollinger Bands and why it's special and how it can be integrated. But more importantly, my favorite is the section on how to integrate the volume analysis that I teach with the PPS indicator. And of course, I also have a little comparative analysis trick using PPS between the cash and the futures market. So instead of looking at the S&P futures, you also should at times look at the spiders and certain times of the years you want to do an analysis of looking at the cash market ETF versus the futures. Now, if you already have had experience with this, I also have a mechanical trading system, which this new mechanical trading strategy talks about the PPS breakout system. And it gives you instructions for placing order entries for day trading, for position trading, where to place your stop, how to set your profit objectives, your instructions for scale outs, as well as how to use this method for end of day and weekly time frames. Just like Amazon trade and the multiple other trades that we did with our earnings plays, we talked about how to apply this breakout method for options traders, selecting the right strike price, selecting the right expiration dates. That is key critical. Now, this will be available. It's not going to be released until Monday, but you can purchase this today or over the weekend for $4.89. We also have a bundle package. If you're interested, we also have a bundle package if you want to purchase both at a very incredibly affordable offer. And that price is available. I just put out the link there for you guys. All right, so if you are interested, you can see this particular link, and you can see how to get that on our website, and it gives you all the details. It is going to be a fantastic way of taking your time during the holidays to study up for what I think is going to be some incredible trading opportunities towards the beginning of the first quarter of 2015. Just remember, we've got, just when you think it's all said and done, we have earnings season coming up, okay? We have earnings season coming up in just less than 30 days. So this is the bundle package. You can purchase both courses for an incredible price. Ladies, you might know this. This price is less than a pair of Ferragamo shoes at the mall. So really great Christmas indicator gift to have both the PPS breakout strategy. Also, as a bonus, just to let everyone know, I don't just throw a course your way. We also will have a 1-hour mentoring online Q&A. Come into the trading room. We'll be talking about how and go through each one of these after you've studied it. So it's important that you order it, you get it, you study it, and then next month, in less than 30 days, we'll send an email invite to all the students and go through the bullet points of these courses. So we're going to have one for just the PPS, and then we'll have a bundle package session. So that way, if you bought the bundle package, you can go to both mentoring courses. So I just wanted to make sure that everyone knows that this is an invaluable educational format. You study, you take the information, they are video modules, and you also get the online PowerPoint presentation together. In addition, we follow up with a live Q&A mentoring session to help you go through any questions and the material with me personally, not recorded. So with that said, we will record that Q&A session, and that will also be available for you as well. So with that said, I want to introduce Adrian to come in, who has some great information as well and teaches exactly, if you want to take a quick 2-minute break, why don't we take a coffee bio break, we'll switch screens up, and we'll come back, be here timely in 2 more minutes, and we'll be right on schedule and on time. And I wish everyone a wonderful Merry Christmas. And at the end of Adrian's presentation, Adrian and I will both be here to answer any questions you might have. So thank you guys very much. Thank you.
Okay, so you might need to, I'm told, size this to your screen so that everybody's got the presentation right in front of them. But let's give this another shot. So my name is Adrian Manz, and my name is TraderInsight.com. I want to thank John for a great presentation and for having us here today. I'm going to talk to you a little bit about my trading business and what it is that I do and how I've been doing it for for the duration, I guess. I've been at this since 1997, so it's actually 17 going on 18 years at this point. And not much has changed in terms of the core of our trading business, but a lot's changed in terms of some of the ancillary stuff that we do. We've added a lot of these first-hour trading strategies. So that's what I want to talk to you about today, since that's been a significant boost to the P&L and the overall profitability, I should say, of the business. But just by way of background, we are both Julie and I trade together. That's my wife. I saw a few of you here who are from either the boot camps or from the trading services, and that's great. I think it's always good to come in and watch what someone else is doing, and then also to be here and get a little bit of a booster shot, if you will, of my trading strategies as well. So our bend on trading was a very, very technical approach. Julie and I we were both doctoral students out of Claremont, and we developed a time that tried to go and handicap what was going on in the market. And then those models became a trading plan eventually that we use every single day, right? So we've got, in a normal day of trading, what we have in front of us is a very, very specific plan that tells us exactly what we're going to do over the course of the session. So we have this on the left. You see one of the core trades. I've got 3, maybe 4 of those every single day. Then I've got a stocks to watch list that always is pretty much composed of 3 stocks. Then I also have stocks that are sort of on the radar, where I'm looking for sector correlations. I'm looking for ways to tie what's happening in the market to some opportunities that might come up over the course of a session. And this has remained largely unchanged over the years. So I've been doing this trading plan now, and I've been doing it for 16 years, sharing it with subscribers for about 8 years, and this has been the core of the business. Now, what's happened over the past couple of years is, well, what's happened over the course of the past decade, let's say, is, first decimalization came along, and that took a little bit off of the the spreads for us. We used to make it a point to always do essentially what you call rebate trading now, where you're always trying to get the spread on every single trade, and that added up, right? Because you were doing eighths, you were doing quarters. As things were decimalized and some more volatility entered the market, the profit targets became a little bit smaller, became a little bit more difficult to make money by taking the spread all the time. So we added sections to the trading plan. So that's where the stocks to watch came from. That's where the radar stuff came from. So it's always, you're always adding to your business and trying to figure out ways that you can push profitability a little bit. Well, one of my favorite things, and a thing that has been incredibly profitable this year, has been the first hour strategies. Now, the first hour strategies, I'm going to say, have been good enough that a lot of days, we load these trades here, just get loaded into bracket orders before the market opens, or conditional orders, and if there's if we can sort of project what the market's going to do over the course of the session by what's going on in the pre-market, then I'll load up a bracket order, if it's going to be really close to an entry price. And if it looks like we're going to be further away from the entry prices, then I just use conditional orders and cancel if we don't get close to the prices. But what really has worked out well has been some opening gap reversal trading, and I think that's going to be, going forward into 2015, probably going to continue to be one of our strongest strategies. And what I'm going to do today is share my best opening gap reversal strategy with you and show you the formula that you can use in TradeStation or any other piece of software to reproduce the gap list that I'm going to show you here. You can also use Microsoft Excel and just develop an Excel spreadsheet to give you the qualifying gaps. It's really a pretty simple strategy, and for those of you who are here who are in the war room with us on Tuesday, Wednesday, and Thursday, you can chime in during the Q&A to talk about your own experience with these things. But these gaps are going to be the ones to keep an eye on. So let's get right into this. First thing that I want to talk about is the notion of range and true range, because you can scan for these gaps a variety of ways, and really what you're looking for is volatility. And over the years, what I've found is that volatility and true range are actually highly correlated, and the true range can be used as a proxy for volatility. So when you're looking at range, okay, range is just the high minus the low, right? Everybody knows this. What's the range a stock did today? You take the high price minus the low price, and if the high was 50.10 and the low was 49.40, then the range for the day was 70 cents, right? That's a no-brainer. True range is a little different, and it's going to take into account gaps between yesterday's closing price, essentially, and today. And what you're going to do is you're going to take the greater value of either the range, the high minus the low, or the absolute value of the high minus the previous close, or the absolute value of the low minus the previous close. And that's a pretty simple notion, really, when you're not looking at it with a bunch of parentheses. Right, in this daily bar, we've got the high price. In the previous daily bar, we've got the closing price. We just subtract that high minus the close. And if yesterday, or if today was 50.10 and yesterday was 49 bucks, then today we've got a true range of $1.10, right? So it's a larger value than the other. And it's important to just bear that in mind. You're looking for, in the equation that I'm going to show you, what you're going to plug in is true range. And this stuff's all available also for TradeStation and Metastock. So if you don't want to program it yourself, you can just get the add-in modules for it. But it's really a simple calculation that we're going to perform based on these true range values. So the first thing to keep in mind when you're putting together any kind of a statistical analysis of anything is that you have some assumptions, and you're going to have to be able to accept those assumptions as being true. First one is going to be volatility has a normal distribution. The second one is that true range is a proxy for volatility. And the last thing is volatility is mean reverting. Now, I've shown this in a bunch of articles that I've written. It's in the books. I've got a couple of books out there that I talk about this stuff in. You don't need to buy them. You can just accept the, what I'm telling you here today. We have shown time and again volatility is mean reverting. And what that does for you is gives you access to this thing right here, which is a normal distribution. And a normal distribution tells you that if you're one standard deviation out, you're out in those red areas there, you've got a 68.2%, let's call it confidence interval. And if you're out in that next band there, you're in the 95% confidence interval for whatever it is that you're looking at. So if you've got a gap open, and the gap open is 2 standard deviations out in terms of true range, then you've got a 95% probability, according to this model at least, that what's going to happen is you're going to get a reversion of that volatility. You're going to get a reversion of that price movement in the morning back toward the area that it traded in yesterday. That's not going to say that you're going to get a gap reversal, that it's not going to extend any further, and it doesn't even say that this whole distribution isn't about to shift. But you've got a very good chance that you're going to be able to pick off some good trades. And over the course of the past year, I'm going to say we've got 3 out of 5 of these that turn into really solid winners for us. And that's a ratio that I'm more than happy to work with. So I've really included this one as a core of my trading business. And I think after we get through this, you'll be ready to go, Monday morning and find some of these, because it really is a very, very simple thing to look for and very powerful once you get a grip on it. Now, for those of you who aren't statisticians or don't, have the mean reversion idea quite down. It's pretty simple, right? That black line in the middle of this thing, that's the mean. That's the arithmetic average of a set of data, any data. The red balloons, those are high volatility, and the blue balloons represent mean reversion. Anytime something's reverting to the mean, it doesn't mean it's going to hit the absolute mean, right? It doesn't mean it's going to go all the way back to that black line. So there's a couple of rules that we're going to apply to these trades that go and give you then profit targets that are based on, let's just say, an objective evaluation of what reality is. And we're going to get into those in a second. I'm going to show you the formula first just because somebody's going to ask. Somebody always asks, you know, what are you using as your standard deviation formula? And all standard deviation is how far, on average, can we expect things to move away from the average. And in this case, we're using 10 days of that true range data. So not average true range. In your software, you have to go, and when you apply this formula to it, you're going to go and you're going to say true range, right? And then in TradeStation, you would do comma 10. And then you're going to do a standard deviation of that. But the formula for a standard deviation, very simple. So the standard deviation equals, for the sum of x1 through 10 minus x bar, and that's just each day's true range, add it up, and subtract from each day's true range the average true range. We square it, divide it by 10, because I'm looking at 10 days. You can use any number of days that you want for this gap equation. Some people have told me that they prefer to get a little bit more aggressive with the gaps. They'll shorten that parameter a little bit. They'll take a week worth of data. Other people like to be more conservative. They'll go out even further and require a larger set of data points. I've found 2 weeks, 10 days worth of trading data is what works for me, so I recommend that's where you start. So you divide it by 10 in this case, take the square root, get rid of the square. That's one standard deviation. So that's what you're telling your software to do. Then what it's going to do is it's going to take this group of data, right? So you got day 1 through 10. This is a stock from a while back that I use as an example all the time. You've got 10 days of your true range data, and you're going to start plugging things into the formula, or your software is going to plug it in for you. Actually, this all happens behind the scenes, right? So you take that group of data right there, and each one has the mean subtracted from it, 1.25 subtracted from each one of those values, right? And then, of course, we're going to square it to get rid of negative values. So if you subtract, you know, on day 3 there you had a 0.6, you subtract 1.25 from it, that would be a negative value. Then the formula goes, squares that out, gets rid of the negative value, and then later you take the square root to get rid of the square. We divide it by n, and what we get, one standard deviation. As I said, the beauty is your software does all this stuff for you, right? But I think it's very important that everybody sort of get a good grip on, you know, what it is they're betting their money on. So one standard deviation is 0.49. We're going to be interested in 2 standard deviations, and we're going to add it to that average, that 1.25. And then we're going to look for the gaps, right? And then you just have your TradeStation or Metastock or Excel sort those up for you so that the gaps are all at the top of your list. And the rules for the trade, you get a gap open, 2 standard deviations above the high or below the low of yesterday's range, right? So you want to see a gap that has air. You want to see a window between yesterday's trading and today's. And then we're going to enter the trade just above the high or below the low of the deepest bar in the gap. And by the deepest bar in the gap, I mean if the first bar gaps higher and the second bar has a higher low, the second bar is the deepest bar in the gap. If the third bar has a higher low than the first and second bar, that's the deepest bar in the gap. And I'm only interested in watching these for the first half hour of the session. I'm not going to watch them, you know, for the entire first 60 minutes, but pretty much we're going to be in and out of these trades in the first 60 minutes. And then it's really pretty simple, right? In Around the Horn, in the first book that I wrote, which was written around a baseball analogy, may or may not have been the brightest thing I ever did to use the analogy, because I've got a lot of people overseas now who read this book and don't really have that good of an idea of what the metaphors are, but you that's the way it goes. You do things sometimes and later say, oops, now I've got to rewrite a book for every single European market that it gets into, but that's all right. This is what it looks like. So this is an opening gap. I call it Baltimore chop because of if you're a baseball fan, you know what that is. If not, just call it opening gap reversals. We have this move, right, from yesterday's close to today's open, and you have progressively deeper bars in this pullback then, or in this opening gap, until we get down to this bar, which is the deepest bar in the pullback. And then what I like to do is look for an entry right above that high. This is in the case of a stock that gapped down, of course. And I'm going to target usually either the open, the close, or the high of that first bar, right? Whichever one makes sense in terms of reward to risk ratio and doesn't push a stock too much, right? If you get a giant range on that first bar, you're not going to look to make up, a $6 opening bar or something. You have to look at sort of what the typical move, the typical wiggle on a 5-minute bar is during the intraday session. But usually on a gap lower, it's a pretty safe bet to use the open, and you're just looking to get in above the high of the deepest bar and then target that open as your profit objective. Now I'm going to show you a couple other things that I do, little tricks. I make extensive use of floor trader pivots. It's different than the way that John uses them. He's got some advanced manipulations that he's doing on those pivot lines. But in my case, I just use the calculated floor trader pivot values that Realtek gives me every day, and use those to develop some profit objectives. I also use some Fibonacci price projections, all of them in their simplest forms, I'm happy to say, at this point in my life. And I think you'll see how those tools apply to these things, and just how easy it is to get some solid projections and have a trading plan in front of you. So that's the most important thing to me always, is to know what I'm going to do before I do it. I want to be able to put together a plan the night before my trading. And I trade out on the West Coast. We're in Pacific Palisades. We're all the way up here. Any further and you're in the ocean, and that's terrific. But the market opens at 6:30 in the morning. That's not so terrific. So I like to have everything planned. Well, the gaps you can't really plan the same way that you can put together the rest of your trading business. But what I've done is gone and made them almost completely non-discretionary, right? So I'm not interested in looking at a list of 50 gaps in the morning. I want to see more like 3 or 4 that qualify as 2 SD moves. And here's an example. This is the one from that data, so a little bit older. The examples of the actual trades I'm going to show you are from the past couple of weeks. But here we've got, this was air gas. This was that data set that we looked at a second ago. There's an opening gap. Now remember, 1 standard deviation was 49 cents. 2 standard deviations then is 98 cents. So if you're going to program this in TradeStation, it's 2 times the quantity, right, of that standard deviation paren true range comma 10, and that gives you the standard deviation then that you're looking for, and you're just going to add that then to you're going to look for it above the high or below the low, and that's all it takes to program up that gap. So in this case, that average was $1.25. We add the mean, 125, plus 2 standard deviations, 98 cents. We need a $2.23 gap in order for this stock to come up on the list in the morning. So in this case, right, that's our gap move, $2.84. So, guaranteed. Rick is calling this one in the room. I've got one of the guys who attended the Miami boot camp last year, is going gangbusters with this stuff. He's terrific at it. He's great at making these calls. Like I said, 6:30 in the morning. I'm not the best guy in the world to be listening to. So I've got Rick in there. He's doing the sort of open outcry about what's gapping, what's hitting on the trading plan, and I'm just trying to automate as much of my stuff and stay awake on my end as I possibly can. But $2.84 gap on this one, and right, here's what happened. So the first bar of the day was the deepest bar in the pullback. When that happens, I'll still take them. I mean, I would prefer that you had a little bit more of a retracement into that, a little bit more of an extension, go out even more than 2 standard deviations. But it's okay if it reverses and it comes down and it hits that low of that first bar. I treat it just as if I would if it had pulled in further. So I'm short just under the first bar. And then in this case, since I don't have a logical target, I'm going to look for a reversal of 2 closing prices. So as price comes down, you see you have that first bar closes, I'm sorry, the second 5-minute bar of the day closes just up off of its lows. The third 5-minute bar gets an even lower close. The fourth 5-minute bar comes up, violates the close of the third bar, violates the close of the second bar, so that's the exit on the trade. Now, let's look at the calculated gap on some recent data, right? Had some pretty big gaps. I'm going to say just about every day. So you're going to get in front of an opportunity just about every day with this strategy. And in this case, we've got a 2SD opening gap in TripAdvisor. These happen mostly on news. I said I was in Arizona talking to a group of traders the other day, and they wanted to know, well, what kind of news is significant enough? What kind of news is too significant? That's a very good question. And I always say if it's like earnings news or some sort of company product news, that's all great, and that's all going to be something that's very, very subject to mean reversion. If what you get is some information that the CEO committed a felony and there's going to be some major shakeup at the company or something, then those are the gaps to avoid. So if it's a headline before the market opens and all they're doing is talking about how terrible a company is, or on CNBC, then you can pretty much avoid them. But anything else, any other kind of news is pretty much fair game, and it is a very news-driven kind of a pattern. So we got a 2 standard deviation opening in this, and let's see if we can get a bigger. Okay, we've got the second bar was the deepest bar in the pullback. Again, these are 5-minute bars. So what we're going to look to do is get long just above the high of that second bar of trading, and it is going to give us a target up at that open, right? So always look to opens, closes, highs, lows. Those are the places that you want to use for your profit objectives. And here's how this one played out, right? So you guys who are here, who are in the trading room every day, these are they're a no-brainer if you do them this way, and they are going to be a real hair raiser if you try to play them by the seat of your pants. So you get yourself your entry point, and you close it out right at that profit objective, right? I don't spend a lot of time trying to get extensions on these because they typically don't extend. A lot of these gaps go back, reverse, and keep moving in the direction that they gapped in the first place. The stop loss on it, right down below the close of the second bar of trading. So you can have a little bit of wiggle in that third bar. This is the part of it that we wind up eyeballing a little bit. Third bar opens, dips down a little bit. That gives us the indication, all right, we've got pretty firm support right around the close of that bar. Use that as a stop loss, and we're off to the races. And the way that we put the orders in on these is I like to use bracket orders. So the way I'll load it up in Realtick is like this. Whatever trading software you're using, it's going to have its own little idiosyncrasies as far as how the order entry is handled. My trading software, I've got a I've got a strategy that I've already pre-programmed that loads things up the way that I want them. Gives me an opening gap ticket that I'm putting together. I'm using stop limit orders in this case, and as you see, the stop price is 72.40. Okay, that's the high of that deepest bar. That's the high of the second bar. And then the worst slippage I'm going to take on this thing is 3 cents. So the price that the trade activates at, $72.40. The worst price I'm willing to accept on a fill is $72.43. I'm going to guarantee you if you put a market order in on these things, you're going to get killed. So just make it a point to just always say, I'd rather miss the trade than have a huge slip. And you know, over time you're going to find out it's going to have a very beneficial effect on your trading business. Then I've got my profit objective in at $73.69. And I've got that stop loss loaded up at 72.09. So you can see there I know my potential profit, I know my potential loss before I ever hit the place order button. If those two things are out of whack, if I don't have a you know, about at least a 1-to-1 or a 1.5-to-1 preferably reward to risk ratio, then I'm not gonna take that position. The other thing that has developed over time and developed as a function of those boot camps is that I have found a lot of people like to take some money off the table at some point in a trade because it makes them, let's say it makes them better managers of their money. It makes them better able to adhere to the rest of the rules because they like to book some profits. So we also set these up, same thing, stop limit orders, right? But you can take a portion off at different levels if the trade has enough room to move and if you're trading enough share size. Now I'm paying $4 aside for my trades, and I do rebate trades, right? So in my case, the cost of trading is not prohibitive. If you're trading 100 shares or something on one of these strategies, you're not going to do this. You're not going to scale. It just doesn't make any sense to pay additional commissions. But you see that the stop loss remained the same. And in this case, we've got an order out there to take off half at $72.99. And the other half in this case comes off at that profit target, $73.69. Money management rules are a big part of my trading, and you know, I'm going to go over those in a second as well, just so that you know why it is that I'm picking levels that I'm picking. So first off, in the core portion of our trading plan, right? You guys who have been around this stuff for a while, you all know. So this is me preaching again. You've got very, very stringent money management rules that we follow. And if you don't follow them, you're going to get burned. And the rules are pretty basic, and a lot of people will tell me that they're too complicated, and I say, you know, if you can't follow 4 rules, you really shouldn't be trading. But, you know, we just get in at the entry. We've got a stop loss. If it hits the stop, we're out. We've got a 50% to target level. When it gets 50% to the target, we move the stop to risk-free. When it gets 10 cents to the target, we move the stop to the 50% level. And when it hits a target, we take off our shares or we start trailing a stop on half of it, right? So that's the core part of the plan. Well, it's really no different for these things. And just because they're discretionary trades does not mean you start risking the farm on them, right? You need to get to where you know there's a point at which the trade is going to be risk-free for you. So other people are saying, you know, we want to be able to take off some money because that's where we get some peace of mind, is I made some money on a trade. For me, peace of mind is all about I've got no more risk on this thing. And what we're doing with the gap trades is the same thing. If I get to move 50% of the distance from the entry to the target, boom, I tell the software, let's move our stop to break even. If it moves strongly in our favor and we hit the profit target, then you know, as it gets closer to the target, we move to the 50% level. Once it hits the target, I'll use like a trailing stop function, and you know, as long as the software you're trading through has a trailing stop server out there somewhere, you're going to be able to do the same thing. And I don't give these much wiggle at all. So if it hits the profit target and it's blasting through, I'll use a trailing stop of like 3 cents, which sounds ridiculous because you know it's going to wiggle back and hit it, but I want to get wiggled out of the trade. I don't want to get hammered out, right? I don't want the thing to come down and you know, collapse underneath me, and then I've got a 40 or a 50 cent loss on it. So these things you're going to keep it real tight. So again, the initial target for a gap opening down, use the high or the open of that opening bar. Initial targets for gap openings up, we're using the low or the open of the opening bar. And I'm going to show you how to use pivot lines and some fib retracements when those levels don't make sense. So if that open or that high or low don't make for a very realistic trading objective, then there's some other tips and tricks that we can use to find those. And that's another one of those things. You know, we do a lot of that stuff in the room. One of them is using 25 tick charts. So if your software has this included, then great. If it doesn't, you know, then maybe consider some other software, or just keep this under your hat for the day that it adds it to it. 25 tick charts are going to take the time element out of the chart and give you a different kind of a plot. So if you've got a stock that's got a really you know, sort of wild range on the open, and you can't figure out where to put targets, and you can't figure out how to trail stops, 25 tick charting is going to give you a real sort of stair-step progression versus what goes on a time-based plot. And when you're using those stairs, all you're doing is every time you get a new band of price data there, you ratchet your stop in behind. Essentially, every time you can see a place to draw a line, we've got a bunch of support here on a 25 tick chart, draw the line, and then as you look back, I trail stops up two lines back. But I'm not going to get into that too much because a lot of you don't have 25 tick charting in your software. You can look on both Trader Insight and YouTube. I've got a ton of videos up there, free videos that you can look at for how I'm using 25 tick charts to time some of these entries and exits. But so just keep that one in the back of your mind. But as far as alternate targets using pivots and fib lines and all that kind of stuff, that we all have access to. So let's take a look. So here we've got Kroger. This was a couple weeks ago, right? Big gap move to the upside. And I took an entry in the room that confused the heck out of people as to, you know, why is he doing that? Well, what I did was I had snapped a line on the opening bar because it was a wide range bar, and I was trying to figure out, boy, we're in such close proximity to that 60-15 R2 level there that, you know, I was trying to figure out, well, is there an alternate place that I can get in? Because I know that if I get back down and test the low of that first bar, I'll be under that pivot, and I've got a good shot at a pivot-to-pivot move. But then I looked at it and I said, you know what? I've got a 75-cent move from that first pivot down to that second pivot, and I don't typically see that kind of range on any of the Kroger bars. So let's go and try to restrict a little bit. Let's try to do some fib ratios here and figure out if there's a more conservative target that I can place on this thing. You know, would I like to make 75 cents on a move in this stock? Absolutely. Problem is the market doesn't typically care how much I'd like to make or what I'm willing to lose. You know, it's better to go find something that's based on levels that people watch. I'm not a huge fib guy, but I know that people follow them, and you know, using an expansion ratio on this one got me an entry at a retracement. So there's a 382 retracement of the opening move there. Just rested a sell stop there, and then targeted the 382 extension on the downside. So 59.74 was the target on this one. It's an alternate way to get into this, right? Because we didn't really have enough room from the low of that second bar down to the low of the first bar for a target to make any sense. We see the volatility. We see that there's going to be a likely move on this. Got a very easy stop in place just above the high of that second bar of trading. So when it all lines up like this, you can use some of these technical analysis tools, pull them out of the toolbox, plot them, right? And you can get yourself in front of a planned trade that otherwise would be discretionary, and you wouldn't have any idea at all where to pull the plug on that outside of saying, boy, I hope it gets down and hits 59.40. Here's another one. This is Meade Johnson. So there's a pivot move on this one. And in this case, we had a gap that gave us an entry above the first bar of trading. Above the first bar of trading put us right up above support 2. And, you know, on a $100 stock, you know, you betcha. I think there's a possibility that we're going to get a move up to that pivot target. There's another one that we called in the room. And, you know, some people will tell you, I've heard the criticism before, believe me, plenty of times, you know, people say to me, well, you know, you're using these pivot lines and, you know, those are just inflections. Those are just temporary inflections in the market. And I'm an intraday trader, and, you know, I believe that I'm in the business of predicting inflections, right? That's where I make my living. So, you know, I'm a believer, and I will definitely use these as targets. You know, it's up to you if you want to use the half band there, use the 100.50 level as a target. That's a good logic to use as well. But in my case, you know, open like this, $100 stock, I'm looking for that big move. I'm looking for a buck on the position. If it falters around the 50% to target level, I've got my stop in place. If it moves up and starts moving back down into the 50% to target level at around 100.49 there, then I'm going to take some of the trade off. But here's another fib retracement. All right, so in this case, I am looking at a very wide range on the opening bar. I've got an entry in that second bar of trading below the close of the first bar. But that gives me, sort of a narrow constraint on where I'm going to look to place my target. This happens when you get these wide range opening bars that wind up closing down low, right? So you're seeing the writing on the wall there, right? It's coming back in. My second bar of trading is going to provide me the entry, and my target in this case is just going to be that first fib extension. So I plotted it from the open to the high is where I had plotted the fib ratio on this one. Could I have gone with a 60-71 target? Absolutely. I would have been happier if I did, but in this case, like I said, I like to plan them ahead of time, load them up in those brackets, and just let the machine take care of the work. There's a lot less slippage, and there's a lot less situations where you get caught on the wrong side of one of these things if you plan it ahead of time and then just trade what you planned. And then here's an invalidated gap, right? So, I know this kind of thing frustrates, a lot of you guys. We see, big move in something, and then it really does do like $3 in the first 5 minutes of trading, and I get some unhappy comments from guys who are, isn't there a way that we can move these things into a different time frame, or take a look at getting into that first bar when it's really moving like this? And my answer is you can do anything you want, and for me, I'm always going to wait for the first 5-minute bar to close up before I make a decision about what to do. And when it does what it did here, where you get this giant move in the first bar of trading, then I'm not going to be able to get in front of that opportunity, and I don't care that I missed it, right? I'm just going to follow my rules and trade it the way that I know is going to make sense for me. So again, for this particular strategy, it revolves around the fact that I've shown time and again, as have other people, that volatility is mean reverting. And, I think it's as much an outgrowth of the fact that, I'm trading at a time of day that I'm not necessarily comfortable doing anything, that I need to get in front of something that is statistically reliable and not based on my discretion, and then the fact that I'm able to pull functions out of the software that I use and get this stuff loaded up quickly in the morning and reliably in the morning just makes this a great strategy for me. So we've done this a million different ways over the years. We've been very, very complicated with it. We've used the implied volatility of the front month contract, used that to then go through and say, okay, all these stocks on this list have to gap by 2 standard deviations of a compounded measure of that, and that worked very well. We did VIX correlations on individual stocks. That worked very well, and the reality of it was this true range manipulation is actually as good as or better than any of those in predicting whether or not there's going to be a reversion. So I've been publishing this one for 11 years in various incarnations, and like I said, this way that we're doing it right now is probably my favorite. Then we've got, in first hour trading, we've got range scalps that we do. So you saw my my core trading plan, and you saw that was primarily based on NYSE listed securities. And over time, and that was because we were both PhDs in psychology, right? So when we started trading, we loved the idea of there's a specialist on the other side of every single trade. We loved that idea for every stock we traded, with the exception of St. Jude, because that guy always, let's just say he was difficult to figure out. But as time went on, the markets became more similar. right? Electronic trading made the NASDAQ and the NYSE more similar. Now when I go down to the floor of the exchange, right, it's almost deserted down there. So, you know, CNBC is in the middle of the trading floor, and you know, not much else is going on down there anymore. A lot of stuff happening electronically. Markets are similar, but they're still different animals. And the NASDAQ stuff works very, very well when I go through and try to predict based on yesterday's happenings what's going to happen today. So for these intraday range scalps, so you know, a few of you here have seen this before. It's been in front of you, the scalper setups. What we're looking for is areas that constrain trading today, and then we're going to plan for what we're going to do tomorrow. So yes, I even plan my my scalp trading. I am not a good discretionary scalper, but I'm very, very good when I've got the parameters set up ahead of time. I focus on ranges that have real clear intraday support and resistance. I want to see swings between those support and resistance areas of about 20 cents, 25 cents, right? So you want to see, you know, you want to see at least a quarter on the quarter point on the swings typically, or 20 cents on the swings. Most of the good trading candidates here, you're going to want to filter your list of stocks, the universe of stocks you're looking at, to 75 cents to $1 of range on a recent trading day. And if you want to trade the opens, this is hugely important. You want to look at just the 10 or 11 NASDAQ stocks that do 10 million shares or more a day. And the reason for this is you're not going to be on the rebate side of the trade on the opens. You're going to be giving up the spread. And if it trades 10 million shares, I can pretty much guarantee you that spread's going to be a penny or two. If you're going to take your favorite stock that trades 400,000, 500,000 shares a day and do this, you've got to wait for the market to settle in, because you're going to get murdered on the open. There's going to be, you know, 10-cent spreads, 12-cent spreads. I mean, that's what we dealt with, right? When we were trading initially, we were eighth of a point was the minimum spread. It's not the case anymore. Now, just about every time you give up the spread, you get killed. So focus on stocks that have very, very high liquidity. Focus on stocks that you know, are easy to get tight spreads on first thing in the morning. So when I plan these, right, this portion of the trading plan is set up so that I know, again, exactly what I'm going to do before I do it. And in this case, you see we've got a short and apple, and I set up 3 sets of bands. So I go through yesterday's trading, and I find if yesterday was a move to the downside, then I bias today to a move lower, and we look at, you know, 109.05 is the entry, and then we've got a 108.84 first target. That'll be the first band intraday. We've got 108.84 down to 108.60. That's the second band that I found, and then 108.60 down to 108.27. I've also got the pivot lines there so that I know where there's going to be inflections over the course of the day. And the way that I set these up, right, you see it here. This is exactly those values that you just saw in the trading plan. The high level, 109.04. Down to 108.84, you should be able to see clear support and resistance there on 11.5. 108.84 down to 108.60, you can see that as well. Price was swinging between there. 108.60 down to 108.27. A little bit of finesse when you're setting these up, right, because they're not perfect. Price behavior is not perfect at support and resistance. It's going to be a little bit spongy. You're going to get a little bit of elasticity around those bands. That's okay. You just want to capture a lot of opens, a lot of closes, a lot of highs, a lot of lows, so that you can see that you found a place that price does something. Then you set these brackets up, and you know exactly that those are the moves you're looking for in the morning. And what I do is I'll look at a stock like Apple in the pre-market, and I'll see, all right, well, is it trading right above 109.04? Is it trading right above 108.84? Is it trading right above 108.60? And if it is, I just bracket that order out, and right on the opening bell is where I'm interested in taking these. I don't really take them pre-market, but they usually wind up just ripping down through one of those prices. And you can see here it wound up in this case opening and popping right down through 108.60 down to 108.27, and that's a trade I'm going to take then, right? So you just have that order rested before the open of the market, and if you do it and you do it often enough, you can just trade the first 60 minutes and be happy and be done. If you want to trade these later in the session, a lot of you guys in the room are, you know, you're like stock junkies or something. You want to keep watching these things all day. Then you want to watch for something like this. So you want to see the stock move up above that 108.60 line in this case, and then make this like check mark move back down through 108.60, and then you target 108.27. So in the case of the morning, right, first thing in the morning, I'll take it on the first tick that moves down through one of those lines we're in. In the case of after the first hour of trading has expired, we want to go and we want to see price move counter to the trend that we're expecting, right? So in this case, Apple made a big move to the upside from that 107.80 low there, came back up, got up through 108.60, and then we wait and we put our entry price bracket order together after it's above that line. So it's like a conditional order, right? You don't want to get filled on the way up. We're not going to rest our stops underneath there the way that we do with the pivot entries. We're going to wait for it to violate the line and then put the order in. So if it keeps going, it goes without us. If it keeps going higher, right? If it goes up to 108.84 without us, we don't care. But what we're looking for is the move back down through 108.60 to trigger us into the short sale. Now, I always only take them. Can you take them between those bands in both directions? You betcha you can. I do not. So I prefer to stick with my bias on the session. If I thought it was going down, then I'm going to keep on focusing on that momentum. And that's frustrating for people when these things reverse and there's a lot of opportunity to go the other way through the bands, but I just like to keep things simple. Here's another one, right? It's almost an apple a day. This thing's on the trading, the scalper plan really, really frequently. In this case, it's a long. You'll see a lot of times I've got it planned as a long one day, a short the next day. I'm only interested in what's happening in price in the very short term, obviously, since I'm trading intraday, right? In this case, we got a long, and we're going from the low side. We're going to enter at 109.25, and we're going to have targets that go all the way up to 109.98. So, whoops, the bands were developed the same way. Not really going to look too much at the bands. You can use fib extensions for moves that you think are going to be significantly higher. And in this case, we had a 109.48 planned entry and a 109.74 first target. And then if it would have made like a check mark move back down through there and higher, we would have caught 109.74 up to 109.97. And then, of course, that pivot extension is beautiful. I didn't get any of that. I just got that first trade because I set it up as a bracket order. And again, I'm fine with that, right? I'm fine with the most conservative entry on all these trades. And, Rick and Ken and some of the other guys who were at the boot camp, they like to push the boundaries a little bit and then keep working with these stocks over the course of the day. And that's great because that means they learn something. And like I said, at this point, I've got so much on my plate every day that I just like to I like to use these as extra money first thing in the morning. Then the next one on this plan, right, Alibaba. So I do trade the hot stocks. I do trade things that are moving. Alibaba makes it onto this thing quite frequently. If you're a TradeStation guy, then it's no problem getting short. If you're trading through a lot of broker dealers, it's no problem getting short on this one. If you're clearing through Apex, if you're clearing through Wedbush, then sometimes it's a good idea to call ahead of time and make sure they can get you the shares. Leave those shares in your account to trade over the course of the session, because sometimes it winds up on the hard to borrow for those guys. But in this case, right, I'm looking at 115.59 all the way down to 114.20. And this is the range that we've got scalps in for the session. And you see here that keeps advancing on me that right off the opening bell, you're moving in the wrong direction. And then the second bar of the day, you've already got that check mark move back down through, gets you from 59 down to 115.07. And then it has another one of those reversal moves, gets you from 115.07 down to 114.55. And quite frankly, we missed the next one because it it doesn't give us that inversion, but it did make it all the way down into that range, down to 114.20. So those volatility band setups, you can really predict nicely what is going to happen over the course of tomorrow's session in terms of where the price behavior is going to be most predictable. So here's Comcast right from the same day, 52.56 all the way up to 53.32 are the ranges that we're looking for, and that's based on the reversal movement made in the prior session. And look at what happened. So it gives you an entry at that 53.05 mark, and then we've got the extension up to 53.32 that we were looking for, and that is an example. When you see them up above the highs like that, because I know somebody's going to ask in the Q&A, how are you generating that that band up there if it's out of the day's price action? Either I'm looking back to the previous session, right? So I'll go back like 1 or 2 days and look for real strong support and resistance areas, or that's just a measured move, right? So I'll measure what the distance of the last wave between 2 lines was, and I'll just project that out. So it gives us a lot of opportunity for the first hour of trading. And as I said, you want to use high volume stocks, trade them right off the open, use that direction before the market to figure out where to put the brackets. Later in the session, you want to make sure they go counter to the trend that you're looking for and then reverse back down through it. And over the course of the session, some of you guys are like I said, very intent on, staying in front of opportunity all day, every single day. The closer I get to 50, the more I like to get out of here and hike on the beach or in the canyon in the morning. So I love doing these in the first hour and then just letting the machine take care of the rest of our trades. But if you're going to look at extending these over the course of the session, you can definitely go and do things like add additional bands, look for more measured moves, take what happened over the course of the session so far and just be very intelligent about where you're going to project price out, right? So if you find more of these support and resistance levels happening, you can just look for price behavior in that channel, and voila, you've got more trades that you can do over the course of the session. So we do have an offer for the webinar attendees. If you want the trading plan, if you'd like to try it, then the regular price on that is $195 a month. We're doing it today, $99 a month. That's 50% off. It's not a 1,000% return kind of a thing, right? This is a plan for, first off, it's our actual trading plan. It's what Julie and I trade for ourselves. It's how we make our living as traders. It's a very realistic trading plan. It's had one losing month in the last since 2006. It's very reliable. It does have losing days. If you don't ever like to have a losing day, this is not going to be for you. You can have losing days. You can have losing weeks. Month over month, it's been profitable. Some of those months have been very lean. On average, it does very, very well over time. So if you're interested in it, then check out the offer. And what I'm going to do is include my first book, Around the Horn, A Trader's Guide to Consistently Scoring in the Markets. If you look on Amazon, they're selling it for $95. So I'm going to include that with the subscription. You'll be grandfathered in at that rate for as long as you want to stay with it. And all that I ask is, give the book a good read before you call me. Make sure you're familiar with the patterns and with how to place the orders and the strategies as you go. And then if you don't understand something, give me a call and I'll talk you through it. So that is what I've got. And then I guess we have got time for a Q&A. And again, I want to thank our host for doing a great presentation. And I've run across John so many times over the years at trading conferences and things, and I just can't believe this is the first time that we're doing something together, because I'm a fan of all the pivot stuff, and I'm a fan of what he's done in the past. So maybe this is the start of a good thing here. There's my email. If you have any questions, Adrian at Trader.
That was very nice. I just want to make sure that the volume level, I don't blast anyone out from your level to my level. We have like I said, I think this was a really good presentation, a good mix of information as well as a good mixture of styles. Nothing, I don't believe, from my end is a conflict. So it's very good stuff as far as the statistical information that you presented, and absolutely we've probably at these events, at these Traders Expos, seen each other in passing, but never had a chance to sit down over the years. But this is a great way to get together and have folks understand there's, as I always say, and Adrian, you probably may agree, but not PETA. And I always open my mouth and insert foot, but there's always 10 different ways to skin a cat, as the old phrase goes, and there's all different styles of trading, whether you're someone that is only interested in day trading and day trading stocks, and as you presented, to find out what brokerage firm allows you to short, if you can, to have to find that. And there's really good as well as any trading methodology that you look at. Risk is, the first thing you always ask yourself is, what's the risk in the trade, right? If the risk is, excessive outside your means of comfortability, then that's not the right style of trading. So with that said, it is a nice way for day traders to look at empirical evidence and look at statistical evidence and say, hey, how good is this stuff? And that's why, both your work, my work is just I think today, a really good combination. So just as a reminder, everybody, Adrian put up, I believe, his Trader Insight page, Around the Horn, his web special. We have ours as well, and for the study course, really great information there for those that are interested. And so at this point in time, I would like for those, if you're interested, just a reminder, this is the web page for the special and, of course, the bundle package. And again, this is all online. We had a question there. I want to answer that. And Adrian, we had a few questions here, so if you don't mind, I'll be the not the older kid on the block, but the moderator, so to speak. John Moganis said, do you offer a service that just tells me what to buy and when, and then sell it via email or something? I'm busy, 5 young kids. God bless you, John. He's self-employed, etc. He doesn't have time for all the course research, etc., so he's looking for an advisory service. And so I think from John's question that came in, I believe, Adrian, I personally have the tweets that we send out, which is not an advisory service per se, but we have PA Stock Alerts, John. PA Stock Alerts does do just that, sends out email alerts for that. And I'm not sure if, Adrian, if you also have an advisory service to the extent where you send out emails. I'll let you answer that question.
Yeah, the trading plan, right? The offer that we posted today is for that core portion of the trading plan. It's the easiest thing to replicate in terms of the results. So what you're doing with that is you can take the so the parts of the plan that I showed you are the detail portions. There's a section of gouge sheets in there that gives you just the breakdown on what the order is that you're gonna place, and you can do it the same way that we do. Like I said, I'm at a point in my life where I've got a 6-year-old, and I like to spend as much time with him as I can, and so I'm with you. I don't necessarily want to be sitting in front of the computer all day. And what I do with the trading plan is I load those up as bracket orders before the market opens. I put the orders in. I've got all the order handling automated on my side, so that all I need to do is place the orders. And then I like trading the first hour because of the volatility, so I actually stay in front of the machine for the first hour. And then the rest of the day, I just let the plan sort of take care of itself. I do the work the night before. I've got an entry, I've got a stop, I've got a target, and I've got the the rules on when the orders are going to change, and all of that is stuff that I can pre-program. So the answer is yes. It's exactly the way that I trade.
Excellent. So also we had, well, I think Brian, probably it's a little late for this. Can you make the slide so they show the entire slide at once? Any event, This presentation was recorded, and it was recorded in 2 parts so that there wouldn't be any problems, and we will combine those and get that link out to you as soon as possible for review. It is a lot to maintain information on a Saturday morning or on a Saturday afternoon or a Monday or a Tuesday or any time period, and so this is information that I think can always go back and review. Mary and Adrian, myself, will all decide what the average length of having this posted on the website should be up. I understand, Adrian, your offer, obviously cannot be advertised forever, so as well as ours. So if you're looking to take advantage of Adrian's great offer, as well as the offer that we've made here at Persis Planet, make sure that you check that out all over the weekend, if not immediately. In the meantime, the information to review the videos, we'll discuss, at least have it up for the next week or so that people can go back and review for themselves. So that just for that. So information can be reviewed. So Quiming Lee asks, can you translate to another language? The presentation might be a little late for that. Adrian, it might be tough to translate our information into a different language, and I don't know which language to, but I'm sure, Adrian, your books were published. My books are in 5 different languages, I believe. I think at least 4 of them are legal. 1 is Chinese, and I'm not sure if it was copywritten. And I'm joking, folks. I'm joking. This trading course is only in English, so it's not translated into any other language. Adrian, any offer there in different languages?
Unless that language is German, I can't help you. But yeah, the books,
brother.
Yeah, the books have been translated into, well, just like John's into a ton of languages. But as far as the trading plans go, right, there's no need to translate those because they're just price levels. And in terms of courses, as I said, the only other language that I teach anything in is German. So that happens to be what I speak.
Wow, pretty interesting, Adrian. We have a little something in common. I only speak a few words in German, but I was born in Germany, Frankfurt. My father was stationed in the service, so I'm a German Army baby. So, yeah, pretty interesting. Great country, good food. So we've had a chance to go over there a bunch of times. Any event, kind of interesting. How full circle life comes. Next is RD asked, and I think your question, RD, was already answered about entries and are those pivots. And William S. says, Dr. Adrian, are your main methodologies mostly mean reverting? I believe that question you answered pretty good. And the other question was, what % of your techniques are trading with trend?
So in terms of things that follow the trend, it's going to be, I follow in the, so the book that I wrote is about sort of 9 patterns that I'm very heavy into analyzing the phase of the market, right? So I'm looking for, actually I'm looking to avoid trading during accumulation and distribution. I'm looking to trade during markup and markdown. And about 60% of the trades that I have rely on patterns that happen with the trend, and then the balance are looking for reversal patterns that are going to capitalize on overextensions essentially in the direction of the trend, where we have I've got a pattern, let's say, called infield fly that I love, which is a reversal after a huge extension. Right, so market overextends, the trend is extremely strong, but the pattern gives us indication that the market's about to give back a little bit, maybe revert back down to a significant moving average. That's about 40% of what I do, and 60% is looking for things like expansions of range and volume. I go through, I pick apart the tape. At the end of the day, I take a look at where the majority of the trades are going off. Are there a lot of block trades going off, big trades? Do I see a lot of Realtek lets me look for iceberg orders. Are there guys out there who are trying to move big size through the market without being seen? And then those things I'm looking to follow the trend the following day if I get a confirmation, that they're coming back for more. So that's pretty much, that's the nutshell, nuts and bolts of what it is that I'm doing.
Very nice, Adrian. Thank you for that answer. We had a question here from Brian, which I'm not sure if he's here, but if he watches the review, are my momentum indicator, the PPS, is it available on E-Trade? And the answer there is no. Ironically, I used E-Trade, not E-Trade eSignal, but E-Trade, I do not have my indicators with E-Trade, but they are available on Thinkorswim, TD Ameritrade's, and that is where they're offered there for their traders for free. TradeStation, we had another question here. So it was Mary Ellen Reese asks, are my Mr. Person's indicators, how much are they in TradeStation? It depends on what level you want. The Person's pivots for all time frames with the buy and sell PPS indicator is available for a monthly fee, or the lifetime professional package is available, which you can always contact our office for more details on. This has been, Adrian, pleasure to work with you, my friend. And I hope everyone has a wonderful and has had a great year. If not, then take this opportunity to brush up and look forward to and embrace the trading environment which we're currently in, because 2015, at least for the foreseeable future going into the first quarter of 15, promises to give all types of great trading, I think, price movements, both from a precious metal standpoint, energy complex standpoint, equities from not just here but abroad, as I've pointed out. And of course, as earnings season is upon us again, we should have what we dubbed for the last 9 quarters a binary event, which for earnings, it's to be able to look at and have an idea and select certain tools to be able to use to identify potential upside or downside moves has been pretty amazing. So with that said, I want to thank Adrian very much for spending his Saturday being here, because as he said, having a young child during the holidays when he could be taking him to the mall, seeing Santa Claus for the umpteenth time is just amazing. So embellish and cherish those moments. Everyone, Merry Christmas, Happy Holidays, Happy Hanukkah, and we will see you. This is our last presentation, I believe, for 2015 and for 14, and the next time we see each other will be in 2015. That concludes today's session. Thank you all so much, and thank you, Adrian.
All right, thanks for having me. Merry Christmas, everybody.